Tom Lee, everybody's favorite bull. Oh boy, he's got some predictions here today, folks. Tom Lee expects S&P to gain over 20% this year. We're going to hear what Tom Lee has to say here, react to that one in this one, okay? Our favorite bull as always, okay? And then, you know, if we're going to listen to Tom Lee talk bullish, okay? We got to balance it out. We got to go a little bearishness. So Morgan Stanley expects 16% earnings drop for S&P 500 companies. So I thought that would be the perfect video to react to there and kind of balance things out a little bit. So appreciate everybody joining me as always. We are now 28,100 plus subscribers strong on this channel. I appreciate everybody subscribe to the channel. Thanks so much. If you're looking to join my private group, I want to invite you to join there and apply there. That will be pinned comment down there. Alrighty guys, let's get into it.
Munstrat Global Advisors co-founder and CNBC contributor Tom Lee. Tom, great to see you. Hope you had a great weekend. Interesting to see your stuff last night. You mentioned a lot of different things. The price breakout, better leadership on Friday at least, better participation in some inflows. I mean, can you rank some of those dynamics?
Yes. I mean, I guess the fundamental question we're asking is, on the second week of June, is there still a case for markets to build upon these gains? And I do believe that's the case, Carl. Foremost, I think that the FANGs did the heavy lifting, but I do think breadth is starting to expand. 8 out of 11 sectors are now above their 20-day moving average, which means they're a positive trend. But that's also starting from a point of pretty reasonable valuations. We're talking 15 times ex-FANG for the market at a time when interest rates seem to be stabilizing. So I think there's a case for multiple expansion, towards 18 times for that, and that's going to get you 20%. I also think the earnings outlook is improving. It's close to 60% now have raised earnings estimates for the year. For industrials, it's actually closer to 81%, so that's pretty shocking. And if we talk about earnings growth improving.
Now remember those numbers he just mentioned right there. The reason those numbers are extremely important for everybody watching this video, well, 2 reasons, okay? First reason is it's very important because of this video we're going to watch next, okay? The second reason that's very important is obviously if you have that many companies raising earnings expectations, clearly things are getting a little better than they anticipated 3 months ago, 6 months ago. And so this is very important. And this is something that can change stock prices, obviously. It can change the way the market performs based upon what companies are guiding for, because that's going to completely change your earnings picture there.
At a time when the Fed could be pausing, and then we know that short interest rose 7% last week when you look at futures contract. I mean, it's all-time high short positions by institutions. I think that's a fuel for the big stocks to kind of stay where they are and the rest of the group to catch up. And I think that's actually why markets could advance another 10%.
Right. Your point about fading inflation came alive this morning in the Eurozone PPI data. And I know this is year on year, but going from 5.5 to 1 in a month really speaks to the base effects. And I wonder, could we be replicating even some of that here in the States? If not for June, then maybe for July.
Oh, that's kind of what we think is very possible, which is that when you look at real-time measures of inflation, now there's things like truflation, or like Professor Siegel's use of real-time rent measures. Inflation's pretty close to 0 right now, but it's only lagged in the
Tom, they made you sound like a mouse. What's going on here, man?
Statistical reports of CPI. So I think the market is beginning to sort of realize that there is disinflation, and that's going to allow the Fed to tolerate easing financial conditions. But if that's also the case, for the last 18 months, companies have been really cautious. I mean, they kind of did a recession in earnings because they stopped spending. And I think that's why we could actually be early cycle.
Tom, even if we seem to be on firmer footing and obviously maybe the earnings threat of a big decline is not really materializing, how do you think we're set up from this level in terms of forward returns? Because there is a line of thinking that we really didn't see a full retrenchment in valuations, any kind of real flush through the economy in terms of whatever, earnings excesses or that we needed to get rid of, we did. And here we have valuations are what they are. Maybe they can be sustained, but I just wonder if we should expect the kind of bull market returns we got used to after previous big downturns.
I am kind of debating that internally as well. I mean, there's like sort of two-step assessment we have to make going forward. One is, was the recession called correct? Because that was a consensus view. And if we don't have a recession, we don't really have a further drawdown. So we know that all this cash on the sidelines and bearish positioning has to change. But that doesn't necessarily mean it's a big bull market. I think the second dynamic, though, is companies have really proven themselves pretty battle tested. They survived COVID and the global shutdown. They survived a huge global effect in the supply chain. They survived a massive inflation wave. And yet investors are saying, well, these companies which didn't go bankrupt in any of those 3 cycles should only get a 15 PE. I think we should re-rate these companies higher because they're inarguably safer credits than governments. And as you know, many companies borrow money at lower cost than the U.S. government today.
Yeah, so, what's my opinion on performance of the stock market moving forward in future years? And kind of what's my thoughts about that, right? So my thought is, and I've shared this, if you watch all my videos, you've heard this thought maybe a few times now. I believe it's going to be a stock picker's market for the next several years. These risks that are out there are not going to magically go away, right? China, Taiwan, what happens there? Obviously, Russia, Ukraine, what happens there, right? Those are 2 major risks that we don't know how that's going to work out. Countries haven't been getting along as well, just to be quite frank, on the economic front. How does all that work out, right? We've definitely seen over the past, I would say, 5 to 7 years, maybe the U.S. move a little more internally, right? How does that affect things, right? And obviously, we had a lot of dramatic things happen. Plus, you had this, what does the Fed want to do moving forward? Are they looking to cut rates? You had a lot of dynamics that are going to, in my opinion, cause gains on the overall indexes maybe to be a little capped over the next few years. And so that's why I believe it's going to continue to be a stock picker's market. And the ones that, know how to pick stocks the best, or know how to identify an undervalued company, right, are going to be the ones that thrives. And the ones that are just throwing money into the index fund are going to severely underperform, in my personal opinion. And so that's my thoughts about that. And I don't see that changing. By the way, completely random, but I know a lot of you guys are hitting bigger numbers in your portfolio. So anybody in the private group that is hitting 7 figures right now, make sure you fill out an application in there. We got the application in the Discord chat. And then for the folks hitting the 6-figure club, we'll send you your diamond award for everybody in the private group, free of charge, obviously. And then for Patreon squad members that are in the Discord chat and you're hitting 5 figures, okay, we got the new 5-figure award there. So completely random, but I was just thinking, I know some of you guys are hitting record amounts in your portfolio. So congrats to you guys. Alrighty, guys, let's get into a little bearishness now.
We've got to think about the S&P 500's Friday rally and that inching the index closer to exiting its longest bear market in decades. A robust jobs report and debt ceiling resolution fueled investor optimism and excitement over AI, also helping drive some gains. But Morgan Stanley analysts say the rally will reverse course in the months ahead. In a note Sunday, analysts led by Andrew Sheets predicting earnings per share will drop 16% this year, a bearish outlook at odds with Wall Street estimates. So let's get back to Ben Laidler, who is eToro Global.
I hope the market drops. I really do. That would be nice. I love stocks for as cheap as possible, so drop it, baby.
Market strategist and Tom Essay, Sevens Report research founder and president. Ben, to you first on this. As you think about the number of calls that have now essentially kicked off our week, whether for the S&P 500 or just looking back at what we've seen so far in the S&P 500 rally to attempt to get out of a bear market, where does that sit with you? Do you believe that the forecasts that we're seeing right now have some weight or have some support or substantiated evidence to them as well?
We remain pretty positive, right? I mean, this has been a massive pain trade for most people this year. The fundamentals have definitively turned, less bearish. And when everyone is, hugely bearish, by some measures, almost the most we've ever seen, that's all you need to drive this double-digit S&P 500 rally we've seen this year and, 25%, for the NASDAQ. People have wanted to call this recession for the last 18 months, and it just hasn't arrived. And therefore, not only are you not seeing earnings fall, you're actually seeing earnings rise. And that's happening alongside rising valuations, which is being allowed by lower inflation, lower bond yields. So this is really the Goldilocks scenario, and it's a massive pain trade for the bears. And frankly, I think it continues. I think the fundamentals are decent. I'm very happy to say that, or to agree that growth is probably going to slow from here. But I think markets are just going to look through it, frankly.
Yeah, tough thing, I think, for a lot of the bears, right, is think about it from this context, right? You have many of the biggest market cap companies that move the indexes substantially. in which their net income is going to grow quite substantially over the next several quarters, right? Meta comes to mind. Their EPS is going to take off like a rocket ship over this next few quarters. Amazon, same exact situation. Nvidia, same exact situation. Those are three of the biggest market cap companies in the entire stock market. And so that's if I was bearish, I would be a little concerned about that. Let's just call it that, a little concerned. Then on top of that, Microsoft's going to keep putting up their numbers. We know Microsoft puts up great numbers quarter in and quarter out. They're pretty much the biggest market cap out there. Apple's a wild card. Apple's the one maybe you see weakness there, right? I think that's the real questionable one. Tesla looks like, if anything, it might be starting to strengthen a little bit, not too much, but maybe a little bit here. And then you still got the Cybertruck wild card coming, later this year into some production and maybe, mass production hopefully next year. So, from kind of that standpoint, folks, that's where it's really hard to be super bearish on this market, to be quite frank.
The Fed, inflation's coming down. The Fed's getting flexibility to cut interest rates back. I think any sort of slowdown in the economy, slowdown in earnings, markets are going to look to the other side. And remember, markets are very long duration, right? The market is not the economy these days, right? It's tech, it's healthcare, it's defensives, it's things that are much more sensitive to inflation, bond yields and interest rates than it is to growth in the underlying economy, I would argue.
Yeah, although you could say that...
and even sectors in certain stocks that you would think would be performing horribly right now, like home building, are doing absolutely extraordinary, right? A lot of those stocks are at all-time highs right now, or 52-week highs. And look at their earnings. They're the strongest you've ever seen for those companies. So it's not like it's for no reason. So, that's where we got a very confusing market right now. That's hard to be super bearish on, at least for the next bit of time here.
The point, the growth in the underlying economy isn't that bad, right? Or not as bad as expected. Guys, I've seen the term melt up applied to the rally that we have been seeing. Tom, you first on this. What does that mean when people talk about a melt up? And does it matter what are the implications of that it's being called that?
So it's sort of a very official term, of course. No, it's just a Wall Street slang, essentially, for a market that won't go down, even if there are headlines that mean it should. And it basically kind of pulls in, right, skeptical investors. So imagine something sort of melting and it spreads as it keeps going. And that's what we're seeing, right? For the past 6 weeks, prior to Thursday and Friday, 5 stocks drove the entire market. Right, there's those 5 AIs mega cap tech names. On Thursday and Friday, it broadened out, right? Tech actually relatively underperformed. And that's where you're getting people with this melt up. Now it's spreading. Now it's going across all the sectors of the market. And to Ben's point, if you're underweight, you got to be waking up today really nervous, because this thing has momentum in the near term and you're missing it. And so now do we create more chasing? And the answer is probably yes.
So, Ben, do melt-ups last?
Yeah, and let me drop a little gem here for everybody out there, okay? So, the longer this year ticks on and the indexes continue to perform well, the more fund managers have to, I repeat, have to start to position long, because they have to catch up to the indexes. So if you're a fund manager, you're way underweight a lot of the stocks that you should have been overweight going into this year, right? As in like Tesla, Meta, these sorts of companies, Nvidia, and you're underperforming the indexes, right? You're in a bad position, because we know these fund managers, it's just very important that they keep up with the indexes, right? A lot of people don't care if they beat the indexes, but you better at least keep up with them. And if all of a sudden you're in a scenario where you're underperforming, you have to chase, which means more and more buying pressure as the year ticks on and you get closer and closer to, the end of December, essentially. So that's another huge component out there. And this is why in the short term, it's so important from the bearish perspective, they somehow get this market down. Because if this baby keeps running, you're just going to have this fueled kind of massive buying pressure all the way into the deep into the third quarter and then into the fourth quarter. That will just be a frenzy at that point in time, because you can't come in with, a 6% loss this year if the S&P 500 is up 16%. That makes you look like you're completely incompetent as a fund manager.
Yeah, absolutely. It depends on the fundamentals, right? And I think the fundamentals are very, very solid. We're not in recession. We're going to have a slowdown. It's probably going to be, a modest slowdown. Companies, corporates are getting their profit margins, back. Top line's been resilient. I think valuations are well supported and investors hopelessly out of position here. So I think as long as it always comes back to the fundamentals, if the fundamentals remain less bad, maybe even sort of firm up stronger from here, I think investors can pretend to be as bearish as they like. But, investment managers get paid to manage money, not to sit on cash.
Well, as well, Ben, you've written around this too, and I imagine both of you have monitored the AI FOMO in some cases as investors are looking across any type of mention. And
there it is, FOMO. Oh my gosh, they always got to describe it as that hype bubble, FOMO. Oh my gosh,
record number of.
It's just funny because AI, I've seen them do this over and over again, where it's these past trends and things that have happened in the market, they don't usually do that, and it's just funny that they're throwing that in there.
From S&P 500 companies in this most recent earnings season, but is the AI move that we've seen attached to fundamentals right now from your perspective, Ben?
I would say absolutely. So I would say two things. So one, I've been doing this a while. I have never seen a company as large as NVIDIA be so flat-footed on.
By the way, I will say this video is a lot more bullish than I thought it was going to be. I thought it was going to be like a very, very bearish video, considering the headline. And now as I'm watching it, I'm like, oh, this is actually more of a bullish video here.
A revenue outlook for the current quarter as they just were on AI. That was the moment that AI flipped from being, hope to being, dollars and.
Thank you. Exactly what I've been saying for like over a week now.
Reality. And I think that's massively significant. Two, this is a lot more than just AI. This is tech cost cutting. This is investors looking for defensive growth, like big tech. This is lower bond yields and what that does to, potential valuations. God help the market or tech bears if we see Apple, really make a go of their, their AR VR headset today. That would just be another driver, to the tech space. Point being, I think there's a lot of drivers to tech here. I don't think, there's only one leg to this stool.
And we're going to talk about Apple more in just a second. But there's something else I'm watching this morning, guys, and that's a new forecast out from Morgan Stanley. For once, it's not Michael Wilson, the U.S. strategist, who's making this forecast. It's actually Andrew Sheets over there. And the team there is predicting that S&P 500 earnings per share are going to fall 16%.
How short are they over at flipping flapjack and Morgan Stanley? That's all I want to know. Oh, my gosh.
This year. Tom, is that nuts?
No, it's certainly against the consensus, and we have to take it with a grain of salt that Morgan Stanley has, probably been the most bearish shop on the street for the past multiple years, honestly. It certainly got it right last year, not so much this year. But I haven't read that report, but I'm going to guess here's their thesis, right? And it goes to what Ben was saying earlier, is that basically if we see broad-based disinflation, right now we're seeing it on the cost side of things for companies. What if we see it on the finished goods prices, right? So what if there are price wars? Remember those? They can come back, right? And actually AutoNation last week kind of hinted at one, right? So if you see prices start to drop in the marketplace, good for the consumer, not good for corporate earnings because margins are where they're going to make their money. So I think there is a risk of that. Is it imminent? I don't think so, but could it happen between now and year end?
You know what stock would benefit in a massive way? There's a stock that I just came to mind that I'm like, oh my gosh, they would benefit huge. If companies had it get that super competitive, you know what stock I'm thinking about? Meta. Why Meta? Well, if companies have to get super, super competitive and they're in a standpoint where they're like, interested in kind of killing their margins in the short term to try to make revenue, right? They're going to spend on advertising like crazy in that sort of scenario, right? If you're talking about that sort of competitive environment, you got to spend on ads. Then at that point, you got to spend substantially. Where's the number one place you're going to spend your ad money as a company in 2023 and beyond? Facebook and Instagram, right? And so I just thought of that, and I was just like, wow, that, if that's a scenario that plays out, some companies absolutely get hurt from that. Other companies in an ultra competitive environment, because when things are great, you don't even have to spend that much on advertising, just to be quite frank. But when things start to get harder for your business, things get more competitive, you better be spending money on advertising.
I mean, yeah, it definitely could.
Yeah, and so who and which companies does that impact the most in your perspective?
Well, I think that really your sort of cyclical companies would get hit the hardest, right? Because your stable demand is going to be there. But if people can't extract greater margins, then we have what I call a falling economic tide, whether it's a modest slowdown or a significant slowdown, we don't know. I think those are the names that'll get hurt the worst. So really, you've got kind of a fork in the road. On one hand, Thursday and Friday should make you very bullish on cyclicals, at least from a technical standpoint. But there's earnings risk here, and if they get hit, then the back half of the year is going to be ugly for them.
I have a feeling, Ben, you have stuff to say about all of this as well.
Listen, I don't have my head in the sand here, right? The economy is going to slow. That's going to take a chunk out of earnings. All I'm saying is, we've been calling this for a year and a half, where if we're not expecting a certain amount of this at this point, then, what have we been doing? And I do think there are plenty of ways to, defend yourself from that. I think, it's healthcare, it's big tech, it's the defensive bits of the market. I would absolutely be steering clear of the cyclicals, of commodities, of small cap, the ones that are going to suffer if growth rolls over here. But the fact that it's happening this sort of relatively late in the cycle, if it does happen, I think means the Fed's in a position to respond to that. Again, which is why I think markets are, some sectors will get hurt more than others, but I think the market overall will just look through to the other side of the Fed cutting interest rates and growth flattening out and earnings recovering.
Yeah, and that gets back to the point of, I've been talking about here for a bit, not seeing the recession in the first half. They're going to push it out to second half. If you don't see it in the second half, they're going to push it out to first half 2024. They're just going to keep kind of pushing that until finally, at some point in time, people will give up on it, and that's when it will actually happen, by the way, when everybody actually gives up on it. And who knows when that is, but that's going to likely happen at some point in the next maybe year or so, if we don't get it, right? But at the end of the day, folks, stay diversified out there. Stay taking advantage of deals that you see out there. There's a lot of deals out there, I can tell you that. And they're in different places than they were 6 months ago or 12 months ago. So appreciate everybody joining me as always. Thanks for being subscribed, folks. I'm going to work on a video for the main channel, and then maybe I'll do another reaction video later tonight or something on this channel. We'll see if there's anything interesting out there for me to react to. Much love and have a great day.